I want to thank you for joining us for this webinar titled PPP 2.0, a summary and update following the Omnibus government and COVID-19 relief funding bill. My name is Carissa Miller. I'm the Program and Communication Specialist for Montgomery County Medical Society. I do have a few housekeeping items before we begin. This call is being recorded and we will post it online for our practices to access later this week. So please be aware of that. We have muted all participants at the beginning of this call for sound quality purposes. To mute or unmute yourself, you can click on the microphone button you see at the top or the bottom of your screen. Or if you're on your phone, you can press *6 to mute and unmute yourself. We do welcome your questions, but we ask that you hold them for the Q&A portion, or you can submit them throughout the presentation via the chat feature. Today's program will provide a brief summary of the numerous COVID-19 support and relief programs that have been provided to date, as well as important updates resulting from the recent omnibus government spending and coronavirus relief package, which included an additional $900 billion in COVID-19 relief. We will also discuss updates about the first and second draw applications under the Paycheck Protection Program, the latest guidance on PPP loan forgiveness and taxation, and relevant highlights from the Omnibus spending package. This is our fourth webinar on legal issues related to COVID-19, and we're very fortunate to be joined once again by David Shapiro and his colleague Scott Mirsky from the law firm of Paley, Rothman. So thank you, David and Scott, for being here today, and I'll hand the presentation over to you.
Great, thanks, Carissa. Let me see if I can screen share without disconnecting everybody. Does that work?
Looks good.
Good, David.
Outstanding. So thanks everybody for joining us today. Scott and I are pleased to be back with you. It has been a bit crazy since we were all together last, including with some new legislation, which in sort of typical fashion was quite chaotic until the last minute of it. What's good, I think, is that there was some clarification on some issues that were very common issues that Scott and I were being approached with respect to the last round of relief that we saw from the federal government. But the other nice piece is I think that with the change of administration, there seems to be some additional focus. I think that we are actually going to be seeing more legislation and even more money. I know that there's at least an additional 1.9 trillion under consideration for relief through the new administration. So I do think that with the change of administration, we're going to see some additional changes to this. And if so, Scott and I'll try to pay attention and try to come back to you with new information as it becomes available. All right, let's see if I get this to work. Great. So what we're going to touch on today is we're going to take a sort of a little step back and look at what this is all about and how this all came into place. And that's primarily with respect to the CARES Act and the Paycheck Protection Program that came out of the CARES Act. And then we'll spend, I think, a little bit more of the time looking at how the new Coronavirus Response and Relief Supplemental Appropriations Act that came out has made some changes to, in particular, the Paycheck Protection Program. We'll just give you a brief note at the end about some of the other assistance programs, and then we'll try to leave some time at the end for some question and answer. With any good fortune, we will have you out of here before your lunch hour is up at 1:15. So let's jump right into it. So the CARES Act, just a quick review. This was the Coronavirus Aid, Relief, and Economic Security Act. This is what we originally discussed with you all the way back. I think our first presentation was in April. This went into effect in late March of 2020. It was initially $2.2 trillion of stimulus money. It was certainly the largest spending program in U.S. history. Scope, it was about 10% of US GDP. So I think that, when we were talking about this in the first program, I had mentioned that it's unusual for a program like this, even a program looking at government spending, to be using words like trillions and billions. And now it seems like it's all funny money that the government is dealing with. Of course, I think that we're going to find out as tax bills start to develop over the next few years in this administration. At some point, we're going to have to repay some of this money into the system. But the real idea here was these were dollars that the federal government found necessary to shore up the economy. This was really to keep everybody from falling onto government programs. This was, as I've said before, and I'll say again, this was not a benevolent government trying to be nice. This was the government trying to plan ahead and trying to keep up. So phase 3 of Congress's response to COVID-19 is where most of these dollars started flowing out of. Phase 1 was essentially some initial money for mostly vaccine development. That was just a trivial amount. It was only 8.3 billion. It barely even moves the needle anymore. Phase 2 was $104 billion for the Family First Coronavirus Response Act. Many of you are familiar with that if you had employees that were seeking time out of the office to care for themselves or care for loved ones that had contracted COVID, or if the kids were out of school, you'll remember that. And then phase 3 was this initial, this $2.2 trillion that came in the CARES Act. But that is what created the Paycheck Protection Program. The primary objectives were to keep people paid and employed. The idea was that one way or the other, the government believed that they were probably going to be helping to keep people employed or at least compensated. The idea was that if they could do it through existing workers or through existing employers, that there was a better chance that people would continue to have their health insurance as well. So it provided an opportunity for people to continue getting pay through their employer, to continue paying taxes through their employer, and to continue getting health insurance through their employer. One of the other objectives was to expand unemployment, so people who did fall out of the employment system were able to have a little bit more of a living wage than would normally be paid through unemployment. I know that was an issue for some people here because people who were entry-level employees or people who were hourly employees that weren't making a lot of hours, some of them found that they could make more money on unemployment when there was the standard benefit plus the supplement. But it's something that the government found was a reasonable opportunity to keep people at least able to pay for their expenses. It expanded paid sick leave. We're going to touch base on that a little bit. It gave some tax relief to individuals, and then it provided some additional money for R&D and COVID testing and care.
Thanks, David. I'm going to briefly discuss the Paycheck Protection Program that came out of the CARES Act, which is probably the most significant portion or the most important portion for the people on this call. And as we can recall, there was several different tranches that came out last year. And if you recall, the first tranche was used up very quickly. And then Congress eventually authorized more funds to be used, and ultimately $669 billion in loans were made available to businesses, and also which then trickled down to the employees as well. The loans, as you know, are managed as part of the Small Business Administration 7A loan program, and they are continuing to manage the current round of funding that is now available. As you may recall or remember, that last time the applications were submitted through banks that were approved by SBA, and that's still the current model, unless you're in a small subset of industries that aren't relevant today. All applications are being managed through the approved banks. As you know, the demand broke the bank pretty quickly, and that's why Congress had the second draw. And as always, with this current draw that's now available, our primary advice, if you already have not, is to get in touch with your banker immediately and get an application in, because these funds will most likely run out. So the time is now. Again, just some general key focus things to remember regarding the Payroll Protection Act is that if you use the money generally for certain approved expenses, which are typically referred to as payroll costs and non-payroll costs. Payroll costs are your salaries, your wages, your and other compensation. It also includes vacation, parental leave, family, medical, or sick leave that you may need to pay to your employees. It also can cover severance payments, possibly group health benefits, including insurance premiums. COBRA payments can also be included. Non-payroll expenses have broadened in the last round. Items number 1 and 2, I'm sorry, and actually that's a typo there, David. I just noticed that it's not, it's PPE items are now included in the non-business expenses. You can also include certain business software and cloud computing to assist with business operations. And then it trickles down to the 3 main topics, which have always been included in the non-payroll business expenses, and that's the business rent, the business mortgage interest, and interest payments on debts incurred before February 15th, 2020. So, and again, if you use things on those in those categories and under certain percentages and following certain rules, you also may be entitled to loan forgiveness. And I will throw the presentation back over to David to discuss some details regarding loan forgiveness.
So you'll recall from one of our prior programs that loan forgiveness is obviously a key consideration for most people who received a PPP loan. So we thought we should give you a very in-depth review, but we're just kidding. We had a long program on this. That you'll remember that there are a lot of tax elements, and there's a application that you have to fill out. The application, we believe, will simplify, but right now, if you are dealing with your initial draw, that is that you received money from the PPP loan program prior to 2021, so the money that was available last year, you can still file for your loan forgiveness. There has not been a significant amount of change in that regard. If you want more information, we actually did do a program on the loan forgiveness with the Montgomery County Medical Society. You can link to it through their website. It links you to a YouTube. So if you have questions about forgiveness in particular, we'd refer you back to that earlier program. We wanted to touch more today on some of the new changes that have come out with respect to new dollars available for lending. So that brings us to the key takeaways from the recent Coronavirus Response and Relief Supplemental Appropriations Act. This was a takeaway or a takeout from the general federal funding omnibus bill. Ultimately, this provided a number of small pieces that together will provide some additional assistance. I think that this really is intended to be a short-term fix until the new Congress and the new administration comes up with a more long-term plan. So, for example, one of the things that it did is it provided for individual stimulus checks. This is something that was available before, so it's now available again. It's up to $600 for adults and children. There is a phase out, so if your AGI, or adjusted gross income, exceeds $75,000 for a single taxpayer or $150,000 for a joint taxpayer, those dollars are going to phase out. Right, so this is really intended to help more low-income, middle-income Americans. The amount that you look at is going to be based on your 2019 tax filings, but you'll get the credit that's going to come through that stimulus program on your 2020 taxes. The big piece, and obviously what we're interested in for this, is that there was more PPP money. This time it's $284 billion. Again, that's with a B. But keep in mind, we were talking about billions with B's before, and the money went very, very quickly. But this is an additional $284 billion that has been injected into the program. The rollout has been a little bumpy because we're hearing information about the timing of the rollout not being exactly what was anticipated, but the intent was that the SBA was going to start accepting applications from small lenders. That is, think more small banks, small community banks, not the big monolithic banks. But they were going to start accepting those applications on January 15th. They were going to open up the general application portal on January 19th. Now, of course, that was a couple of days ago. However, I was on a call with a client and their banker who happened to be from Truist, which is what used to be BB&T and maybe SunTrust. I forget which two merged. I've actually never heard anybody say the name Truist without referencing one of those other banks, because otherwise nobody knows what Truist is. But the banker from Truist said that they are not able to file applications yet. What they have been doing is they had reached out to their clients who had taken initial draws on the PPP loan, and they have basically sent out information for them to prepare new applications, and they're basically creating a queue so they can submit these when they're able to actually get their applications filed. I don't understand why that is, since these were supposed to open up for general filings earlier this week. But obviously, if it's something that you're interested in, either a second draw or an initial draw, then you should be contacting the bank that you did your application through. If they're not able to file for you because they're a large bank and for some reason they're not accessing the system yet, you don't have to use the same lender. I think a lot of people find it easier to do that because that bank has already been through the loan process with you once. They may have a lot of the data that you need, but there's nothing to keep you from going to a small community bank to see if they might be able to help you get your application in earlier. And again, that's important because we do expect that the money is going to run out. Right now, unless there's a change from this Congress administration, applications are going to be accepted through the end of March. To be eligible for a second draw, so this means that you've already received an initial draw. To be eligible for that second draw, you have to have no more than 300 employees. That's a change from the initial program. The initial program was at 500 employees. I think that there is some understanding that companies, even if it wasn't their intent, companies have shrunk. So I think that that's a recognition of that. So you have to have no more than 300 employees. You need to be able to demonstrate that you've had at least a 25% reduction in your gross receipts between comparable quarters in 2019 and 2020. Scott and I were talking about this. We believe quarters means your traditional calendar quarters. There has been some question as to whether you can look at any 3-month period. We don't believe that to be the case, but we have not seen definitive guidance on it. So we're assuming that at least for doing your initial calculations, you should be looking and comparing your calendar quarters from 2019 and 2020. And of course, the same concept is in play here. You have to use, or you have to agree that you will use the full draw amount for PPP authorized uses. That is primarily your payroll costs, right? Paying your people, paying their benefits, those kinds of things. And then you can still use a portion of it for the non-payroll costs. That's the PPE and your rent. There's been some expansion on that, and Scott will touch base on that for us in a minute. If you haven't received an initial draw, if you never filed for an initial PPP loan, or like many people, you just didn't get in the queue before the money was all gone, there is still an opportunity to file for that initial draw. That brings you back a little bit to the more common rules that were in play last year. That means you have to have 500 or fewer employees. So it was a slightly larger pool that was able to participate in that initial program. There are some differences in that number, but they shouldn't apply to anybody who's on the call today. That really applies for people in the accommodations and in food service. It's also important to note that there was additional comment that you can still apply if you're a sole proprietor or self-employed or an independent contractor. Obviously, the reason for that is that if you're an independent contractor, for example, you can't receive PPP funds and through the company that you're working for, because that company won't be able to treat that as a forgivable expense. So, for the most part, if you're a independent contractor or self-employed, you have to seek your own PPP loan. There are some quirks for self-employed and sole proprietors that have to do with how you pay yourself and how you track your revenue. So it's a good thing to talk to your accountant and to talk to your banker about your financials to see if you would qualify. The SBA is currently accepting those PPP first draw applications. So if it's something that you're looking to do, you should be able to get in touch with your bank and get that in process right away. The benefit of the PPP program is even if you didn't qualify for the forgiveness ultimately, these are still very, very beneficial loan terms. We're talking 1%. We're talking 5-year maturities for loans that were issued after June 5th of 2020, and there are no personal guarantees. But of course, the beauty of all of this, and it's even more appealing now than it was last year since we've gotten some additional clarification from the program, is that there is a forgiveness opportunity here where you don't even have to pay it back. Scott, I'll turn it back over to you.
Sure. So when Congress or the committee was looking at the new regulations that were just recently issued, they recognized that there were a lot of problems with the first the round of money that went out last spring and summer, that it essentially let certain groups were not able to access the funds. And that's why they've done a better job this time around providing priority, or I guess set-asides for certain groups who were potentially not given priority last time. And that includes small businesses, minority-owned businesses, and people who have run businesses or clinics in underprivileged cities and different groups that were sort of disenfranchised by the process because there wasn't a large incentive for the big banks to loan to smaller businesses because the banks essentially get paid a percentage of the amount of the loan. So obviously if you were a banker, you were more excited to lend, a higher loan to a big outfit than you were to a smaller business. And because of that, the smaller businesses were forgotten. And so now they've actually set aside amounts for small businesses, which they define primarily as 10 or fewer employees. And those and there's money set aside both for smaller businesses that are going to be requesting their first loan, and then there's a separate tranche of money for small businesses that are requesting their second loan. So if you are 10 or under, you're going to have a separate amount of funds to draw from, or your banker is essentially. So there's a greater likelihood that you will not be forgotten this time. But again, so there's $284 billion through the PPP 2.0. There's $20 billion for businesses in low income communities. There's $15 billion for economically endangered live venues, movie theaters, and museums, because that was obviously another industry that was really hit hard and was given priority moving forward to help them with that. And likewise, restaurants and hospitality were given different kind of priorities and special rules, which we're not going to discuss today. But I do think it's important that when you hear other people talk about the PPP program, you sort of have to make sure you're talking about the same thing, and that you're someone who owns a restaurant who's thinking about getting the PPP could be using different criteria or different tests and different repayment obligations and different ways to calculate things. So what we're discussing today is the more general rules that apply to most businesses, but just be aware that there are exceptions for industries that have been heavily hit. David, can we move to the next slide? Thanks. So we really wanted to highlight the major changes. So what's different from the first round or the round last summer? And the major clarification was that business expenses paid for with tax-free loans under the PPP are tax deductible. This was a major issue. This is contrary to what we originally understood from the SBA and the relevant guidance and from the IRS. And it was a big unknown, and it creates a huge tax advantage for any individuals or businesses or practice groups that took PPP loans. And it's going to sort of be retro, or it's going to count that way both for PPP money that you received in round one and round two. So it's kind of a retroactive clarification. So that's a big win for the practice groups. You can also, when you look at your covered periods, I know last time there was, you could use 8 weeks, you could use 24 weeks. You still can use the money anywhere between 8 to 24 weeks. You can decide your covered period, and we're still going to have that same 60-40 split between the payroll costs and the non-payroll costs. So it's very similar to how it was last time, but there isn't those issues regarding how many full FTEs you have and how many full-time employees you have and who is employed when. It just seems like everything is simplified. This go around, it's a $2 million cap on your loan amount, but really it's 2.5 times your monthly payroll costs, which is very similar to what it was last time. It just cannot exceed $2 million. And again, you can look at your average monthly payroll costs. You can go back as far as what your average monthly payroll costs were in 2019, which is probably going to be the most advantageous period to look at. You can use a different 12-month period in 2020, but that's probably not going to be the most beneficial. It's probably going to be best to use your monthly payroll costs back from 2019. And I just pointed out that this is an example for restaurants. They're allowed to get 3.5 times their monthly payroll costs. So that's just an example when you hear different entities or organizations talking about the PPP money. It is slightly different for different groups, but for everyone on this call, it's going to be 2.5 times their monthly payroll costs. The other big difference is that they're making the application process easier. There are going to be new forms that are coming out, and it's my understanding that they can be used for PPP money loans in round one or round two. It's supposed to be super easy for loans under 150,000. Apparently, hopefully, that it's just going to be a real simple application. You're going to have to make some certifications that the money was used appropriately, and hopefully it will expeditiously be approved for forgiveness. If you're in a higher amount bracket, then the loan is going to be more scrutinized. So the less money you take, the easier the application process for forgiveness will be.
Scott and I are also going to use a portion of that to spell check our slide here. So
yes. David.
All right, one of the other big changes, this was an unknown, this is really a benefit to employers who have been hit hard by COVID, is that you may recall from one of our earlier programs that there is something called the Employee Retention Credit. One of the changes now is that you can now use that employee retention credit even if you received a PPP loan. That wasn't doable before. This is for employers who either fully or partially suspended operations due to a COVID-19 order. So that means you were in a situation where you had to close down, or for a calendar quarter in 2021. That's, that would be right now basically. And you experienced more than a 20% reduction in your gross receipts for the same quarter in 2019. So this is really intended to help companies who were hit hard. This is not intended to just help patch things over. This is for companies that really had a close down and a significant drop in gross receipts. What it does is it allows the company to apply to use certain of their qualified wages and get a credit for them. And these qualified wages, the time period for what you're using has also been extended. So it would be any wages that were paid between March 12th of 2020, and that's now been extended through June of 2021. The credit's now 70% of the qualified wages. It was originally 50%, so it's actually a bigger piece of the wages. But there are some limitations that would apply based upon the number of employees that should not be relevant to most groups here. It is a maximum credit of $7,000. So this is not intended to make everything go away and make all of your problems better, but it is intended to give you some assistance. You can't claim the same wages for a PPP loan forgiveness and the employee retention credit. So if you're seeking forgiveness for dollars that you paid out, you can seek forgiveness and not have to repay that piece, but you can't also take the PPP credit. So if you have other wages outside of your PPP loan that you were still using for paying employees and you want to try to seek the credit for that, you should be able to do it. There are a lot of nuances to this. This is something that you want to sit down with your accountant and look at your payrolls, look at where your dollars were coming from. If you were on Scott's and my earlier programs, you remember one of the things that we really stress for people getting PPP loans is allocate and track your PPP dollars separate. And this is a perfect reason for why you would want to do that. So again, if you have payroll costs that you were paying or wage costs that you were paying to your employees above and beyond what you used your PPP dollars for, so dollars that you've used but you did not get credit or forgiveness for through the PPP loan, you can now talk to your accountant to see if you can get the employee retention credit, right, which is going to be up to 70% of the qualified wages. It's a complicated analysis, but if you've tracked your books and records properly and you know where you spent your PPP dollars, your accountant should be able to help walk you through that to see if you can take advantage of this. Again, this is important because you couldn't do this at all before if you had received PPP dollars. Now that's an option. You can't double dip, right? You can't use the PPP dollars and take the credit for wages that were paid using PPP dollars. But for most employers, your wages over the past, now 9-10 months have gone beyond what you received from PPP if you took an initial draw.
Okay. We wanted to briefly touch on the Families First Coronavirus Response Act, which was a topic on some of our earlier webinars. And I just wanted to note, because this most recent act did not extend the Families First Coronavirus Response Act. It expired on December 31st, 2020. And as you may recall, that was the act that allowed or required certain employers to provide their employees with 80 hours of paid leave related to coronavirus. And it also required employers to provide up to 12 weeks of leave for individuals who had childcare issues and could not return to work. And there was exceptions for the healthcare industry. And so you may or may not have been complying with the Families First Corona Response Act, and you may have been in fact exempt. But it is important that it is no longer mandatory for any employer. However, employers can still voluntarily offer the FFCRA type leave, and you could also get, and if you chose to do so, you could take advantage of the tax credit associated with that leave. You can't do it again for an employee who already was out on FFCRA leave, but if you had a new employee, or not a new employee, another employee who was infected with COVID and you were so inclined to give them the 80 hours of paid leave, and again, it's not mandatory, you could do so and take the be eligible to take the tax deduction. Right now, that would have to be for leave provided between now or January 1st, I guess, and March 2021. So communicate with your employees about expectations and their leave options is always very important, so your employee is not surprised. As most of this stuff that we're talking about, this is the current information that David and I have for you right now. We anticipate that there will be changes, updates to possibly the Families First Coronavirus Response Act, as well as to the PPP program. I think we're definitely in a changing environment, and things may change rapidly. And I think that the changes that we see are going to be probably moving forward type changes, but there may be additional relief, additional funding, additional obligations that employers may need to make to provide to their employees. And stay tuned, and keep your ears open.
So Scott, I don't know if you've seen this. If you're a Maryland or a Montgomery County employer and you're obligated to provide leave under the state's sick and safe leave program or Montgomery County sick and safe leave program, have you seen any guidance about whether if you provide that type of leave, you can then seek a credit under the FFCRA provision or this extended credit provision?
I would think that you probably could, assuming that the leave that you're providing fits into that the person's taking the leave for COVID-related issues. I think that was implied in your question, I assume,
Yeah.
David.
And most of the
I haven't seen any guidance on that, but I would think that you would be able to, provide them the leave under the policy and still take the credit. The one nuance I would say is that the FFCRA leave was not supposed to be was supposed to be additional leave and not deducted from the leave bank of the employee. So I think there still needs to be some guidance on that issue, but it's a good question.
Yeah, it's an interesting issue because this is not technically FFCRA leave anymore. It's just the tax credit that might come from providing that type of leave to employees.
Yeah, I mean, I think the safest thing would be that you probably would have to take it as it would have to be some sort of additional benefit that you're providing the employee on top of the Maryland sick and safe leave.
Okay. All right, back to you.
Great. So as David was saying, in the first go round of the CARES Act, there was a $600 supplement provided to employees who were unemployed or on furlough status, whatever it may be. And there was a lot of workers who felt like they could almost do better by not working, by receiving their unemployment benefits. They were making more than their employer was paying them. And Congress sort of recognized that tension, but still wanted to, I guess, split the baby in half and allowed for a $300 amount additional supplement on top of what an individual will receive through unemployment. Unemployment fluctuates, but it's my guess that now someone who's on unemployment, could probably be receiving somewhere between, maybe around $600 a week, $600 to $700 a week with this extra benefit. And before, they were receiving over $1,000 a week, which was very enticing for some low-income workers to stay at home. So, Congress is trying to meet it halfway. So it is, just so you know, there is that extra benefit. If your employees do need to be furloughed or become unemployed, they would be entitled to the $300 extra supplement. And I also wanted to point out that typically, if you have any independent contractors or self-employed workers that are sort of affiliated with your organizations, they typically are not eligible for unemployment, depending upon how they're structured. But under the CARES Act, they have been granted the ability to apply for benefits, and that's been continuously extended, and now it's extended to March 14th, 2021. So that's just sort of an FYI if you work with independent contractors and you're curious about what their situation is. Now, of course, an independent contractor could still apply for their PPP loan, and that's their decision, which way they want to go, if they want to apply for a PPP loan or if they wanted to go on unemployment, assuming that they're not generating the income that they were pre-COVID.
So there are, while not the purpose of our discussion today, Scott and I did want to remind you that there are some other programs that are available and that you should be keeping an eye out for. So, there are still these EIDL loans, the economic injury disaster loans that you've heard about. Those again are offered through the SBA. So that may be an option if you still need additional assistance. Maryland has a small business COVID-19 emergency relief grant. That you have to look to see if money is still available. It comes and goes. There was a significant amount of money earmarked out of the new legislation for states. So hopefully the states are going to be pushing this back into their grant program. Similarly, Montgomery County had a grant program. It was the Public Health Emergency Grant Program. It ran out of money, much like the PPP, very quickly, but it is worthwhile to pay attention to see if these things become available, because we anticipate that as these new dollars get earmarked and pushed down to the states, that we are going to see some local grants becoming available again. Likewise, there may be some additional federal healthcare program funding grants. Some of you may have received grants either through HHS or one of the other departments that you're involved with. So again, we expect that there's going to be some supplemental funding into those programs as well. And finally, much like we talked about, the tax credits for providing leave and whether or not you're entitled to retention credits, it's certainly worthwhile to talk to your accountants as they watch this new information unfold. There may be new tax considerations that they can help you with as well. So again, not the purpose, but we just wanted to remind you that there are other things out there other than just the PPP loan that you should keep an eye on, because some of these grant programs can provide real dollars very quickly, and they're grants. So it's essentially free money. Although I say that grants aren't always free, grants often are taxable. You have to be very careful about how you say that. That's why the issue that Scott noted with the PPP dollars now being non-taxable, is the dollars that you spend being deductible, said another way, was so important, because grants are often taxable. But even if you get taxed on a $10,000 grant, you still get to use the other piece of it. So do pay attention to those as they become available. All right, so Carissa, we can open it up to some questions. I don't know if you want me to stop the screen share, if you need to keep it, or if it's fine as it is.
It's fine to stay up or to close it, whatever you would like. I'm going to start with our pre-submitted questions here, and then we'll work over to the ones that have been submitted via chat, if that's all right.
Absolutely.
So the first one that I've got is, I would like to know if HHS stimulus general funding that we received back in April should be considered as gross receipts of the PPP 2.0 gross receipts, and also what to do about EIDL advance.
Okay, so that is going to ultimately be a great question for your accountant. However, I would say that the advances and the EIDL are different from the PPP. So my understanding is that if you received a EIDL loan, it is treated separate, though you can, in some instances, use the dollars from the PPP to pay some of the EIDL. So again, important to check with your accountant about what you can use to repay that EIDL, because if you used your EIDL loan for paying otherwise PPP approved expenses, you may be able to use those PPP dollars and still get forgiveness. My understanding is that the grants that were paid out of HHS are completely unrelated. I was looking today to see if I could tell whether or not any additional funds were earmarked into that program. I didn't see that on a quick look, but there may be additional dollars coming. Again, those are separate from the PPP program, and unless there is a legislation that goes along with that, typically grant dollars are deemed to be taxable, right? So it falls into your income for the practice. But again, separate from the PPP, definitely talk to your accountant about the specifics about whether or not, if you have PPP money, you can use it to pay, for example, your EIDL loan, which is a loan, not a grant. Although I couldn't tell from the question, the EIDLs in the last go round had a little quirk to them, which was that there was an initial $10,000 that could be available, which was a grant, and that was a non-repayable grant. So the initial piece that came out, you got to keep and not have to pay back. But very complex question, very good question, but a lot of it's going to be very nuanced. And it is, if you've received a PPP and an EIDL, and you've also got some HHS money, whether the HHS money was an advance or a grant is important to know. There were some advance payments that were paid. The advance payments were going to ultimately be deducted from future distributions to the practice. The grants, again, are treated differently. So if you got all of those things, it is very important as you guys are preparing your taxes that you make sure you flag that for your accountant and you have them walk through each piece of it with you.
Okay, thank you. The next question is, if we received a first round PPP, what are the requirements to receive a second round?
So that was what we touched on a little bit above. You have to have fewer than 300 employees, which is the case for most of us. And you have to have had a 25% decrease in your gross receipts for a matching calendar. We believe it is a calendar quarter from the previous year. So what you really want to do is you want to look at your financials, your P&L for 2019, 2020. You want to look at the similar calendar quarters. You want to see if you had that 25% drop. If you did, and you have fewer than 300 employees, you want to get on the phone with your bank and make sure that you're starting to get that loan processed. Sorry.
Okay, great. So if question is, if we have one quarter reduction of 21% and another quarter of 18%, are we eligible to apply for the PPP loan, which I understand would not be forgiven?
We're talking about a second loan. Did they say it was a second loan?
Yeah, they're asking about the second loan.
I don't think they would be eligible. Is that your understanding, David?
I think that's correct. I think that it has to be looking at the complete quarter, and you would have to look at one quarter. You can't average out between two quarters, for example, where there may be a different answer, which is what Scott and I have not been able to get clarity on, but the statute itself simply references looking at quarters between the corresponding years. It does not state specifically that it has to be a calendar quarter. So, it is worth probably seeing if any guidance comes out that would provide that you could look at something other than a calendar quarter, because if you had a significant drop between, say, for example, that overlap to calendar quarters, and you were able to look at quarters from one year to the next, but not necessarily a calendar quarter, just a 3-month period, maybe there would be an opportunity there. But otherwise, as we understand it, we are looking at calendar quarters. And if we're just looking at the calendar quarters, I think it's unlikely that they would qualify for the loan.
Okay, thank
Sorry.
you. Our next question was essentially the same, asking if there was any other documentation they could use other than just the quarterly. So it sounds like that's a no for now from what we know.
It's certainly, there's no harm in reaching out to the banker that you work with the last time around or your accountant, because to the extent that they have been processing the loan applications, they may have additional information that would be helpful. But our understanding is that we're really just looking at the calendar quarters.
Okay, we have another similar question from an audience member, which asks, for the 25% reduction in income caveat, do you have to show just one quarter or more than one? And also, if you received PPP money, does that have to be included in your income for the quarter if you are trying to show loss of income?
That second one is a terrific question, because I don't know. Let's answer the first one first. My understanding is that you just have to look at a corresponding quarter from the previous calendar year. So you're going to look at your 2020 Q3, for example, versus your 2019 Q3. I have not seen anything that suggests that you have to provide additional financial data beyond that, other than what's called for in the application, but for the drop. As far, what is very interesting is the clarification that we received through this last bill basically said that you do not, that you are able to deduct expenses that were paid with your PPP dollars. That was a huge issue for, particularly for employers that are not calendar year taxpayers. So if you're a corporation and you have a fiscal year end that's something different than December 31st, I know we're getting into the weeds, then that could create a huge issue for you as to whether or not you could deduct those expenses. What we don't know is we believe, and I don't know if I've seen any writing on this, and Scott, I don't know if you have, is that my understanding is that you do have to reflect the PPP dollars that you received on your financials. So it is not that you got money that you don't have to account for. The real difference from the clarification that we received, which was, there are questions as to whether or not it was a good idea or a bad idea to not have these things be deductible or to have them be deductible. But where that issue comes into play is that if you received $100,000 and you used it for 100%, for example, for payroll costs, you file your application, that complete $100,000 is going to be deductible to the company now because it was used for a deductible business expense, i.e. wages to employees, right? I have not seen anything that would suggest that in looking at your financials for purposes of qualifying for a PPP 2.0 loan that you don't have to take those PPP dollars into income. Scott, have you seen anything about that?
Well, I think it talks about gross receipts.
Yeah.
So I'm not sure that that would be considered as part of your
Of a
income.
receipt.
Um,
Yeah, again, it is, it may be that the banks that are processing these applications at a furious rate right now, it may be that your banker or your accountant who's preparing this information for the bank, they may have additional information on that. I have not seen that.
yeah, I haven't seen any guidance on that.
Right.
Okay. So an item for us to follow up with them on, and to also encourage you to speak with your own accountant about it as well.
Yeah, certainly if Scott and I can figure out an answer to that, we'll send it to Carissa and Carissa can forward it back out to you.
Okay, great. Do you have any idea how long it's taking for the loans to be forgiven after the forgiveness application is submitted?
Yeah, I think that depends on how much money you were granted. I think that it's happening fairly quickly with smaller amounts, loan amounts that, certainly ones that are in excess of $2 million are being scrutinized a little bit more thoroughly. So I think it depends, but I haven't really heard of people complaining about a delay. So I'm assuming that it's happening at a regular pace that isn't too frustrating. But it will depend on how much your loan was.
And I think there's going to be some ebb and flow with that based on the number of forgiveness applications that are received. I know that the last couple of clients that we had in transactions where the forgiveness was a key piece of the transaction, it was estimated that they'd hear back within 2 or 3 weeks. So although the one that told us 2 weeks, we did not hear within 2 weeks, but we did hear within 3. So maybe 3 weeks is a little bit better, but for both of those, when they were filed, it was estimated that it would be within 2 or 3 weeks. So I think that as this gets a little bit later in the year and you see a lot more filers submitting their forgiveness applications, I think that it may slow down a little bit. But one of the reasons that the loans that are under $2 million are moving through a little bit quicker is that, frankly, there's really just not enough manpower for reviewing all of these applications. So I think they are trying to move smaller ones through more quickly.
What are the terms of the 504 micro loan program under PPP? Do we need an economic development approval? And where could we learn more about this application process?
Scott, are you familiar with the 504
I
program?
am not, but I believe that it's run through the SBA. I think there's information on that on the SBA's website on that program.
Okay, we'll make a note to include a link to details about that application process in the post-event email. Is there an ERTC for both 2020 and for 2021? And what is the amount of the revenue loss required for each?
For the ERTC, I'm missing the acronym. What is?
The employee retention credit.
Oh, I gotcha.
I think
I'm
you
not-
might have addressed that in your slide.
And Chris, can you repeat the question then?
Sure. Is there an ERTC for both 2020 and for 2021? And what is the amount of the revenue loss required for each?
So for 2020, I think that it had to be a 50% adjustment. You had to have a 50% revenue loss. For 2021, they reduced it so it's now a 20% revenue loss. What I don't know, I believe that they are being looked at as separate calendar periods, so that your 2020 would be treated different than 2021. I don't know that for certain. I don't know if that they were only looking for when it was applied for, but I think that they are looking at them as separate time periods. Scott, have you seen anything different on that?
No, I think I think that, yeah, I think it is a different time period.
Okay, this next question reads, we are a cardiology practice. Our regular revenue was down 28% in Q2 compared to 2019, but we received call coverage money from a hospital for 3 months, January through March of 2020, all deposited in April, which made our gross revenue less than 25%. Should we look at strictly our main revenue, or is this supplementary income also?
I guess that goes back to the question, although I think that for a practice of this nature, I think that call service contracts are probably going to be deemed to be part of gross receipts. Again, it's a nuanced question that I have not seen come up before. But I think it's a little bit different than looking at, for example, how PPP dollars came in, which were, a loan or a grant dollar versus dollars from providing services. So, the people that are drafting up the applications, that they may have a better sense, but I suspect that dollars from services, which is, I think, where those call service contracts would fall under, I think is just going to be deemed part of your gross receipts.
Yeah, that's what I would think that to be correct too, David.
Yeah, I mean, I'm just thinking we have a number of practices that have similar type of agreements, and at least on their financials, those revenues are not tracked differently. I mean, obviously we know what's coming in from insurers versus cash versus, loans versus these types of support contracts, but it is all treated as practice revenue.
Okay, great. And then our final question that we have is, does your initial PPP loan have to be forgiven before you can apply for the second PPP loan?
Then I believe the answer is no. I think that you can, if you're using it, the requirements for the use of it still have to be the same. I have to look back at the application for the second round. There may be a statement in there that says that you're using or have used all of your PPP dollars for PPP approved expenses, but I do not believe that there is a requirement that you've finished using all of your initial dollars.
Okay, great. Well, for everybody who's still with us, thank you for staying with us for the full duration of the webinar. If you do decide that you'd like to look back on this presentation, we will get it up for you later this week. And we're also hosting the same webinar a little bit later today. So if there's anyone in your practice who maybe wasn't able to join us, you can absolutely refer them, and we will get them registered. So I just want to thank you all for joining us. The place that it'll be posted is on our YouTube channel. So we're going to include a link to that in the post-event email. We'll try to also include the slide deck from this presentation there. So don't forget to like and subscribe to see more videos like this one. And then there's just a couple of other things I wanted to let you know about before we do hop off the call today. The first is that MedChi continues to coordinate all clinician calls with Dr. Howard Haft from the Maryland Department of Health on COVID-19. So they do a sort of surge briefing on Mondays at 5:30 p.m. And then they do a more in-depth presentation on Wednesdays starting at 5 for a full hour for that one. So if you'd like to register for those, please visit us at montgomerymedicine.org. And then MCMS has a COVID-19 vaccine toolkit that we've made available on our website. So that can help you get your staff members in to be vaccinated, but it can also help your practice prepare to offer vaccinations in your practice and take you through the steps that you need to complete to get that vaccine ordered. So with that, we'll go ahead and close out the program today. Thank you so much to our presenters, Scott Mirsky and David Shapiro, for being with us again for this great presentation.
Great. Thanks, everyone.